what's one idea that you hear from the majority of buyers agents that they promote that you disagree with?
Yeah, that's a really good question, Bush. I think it's the more the quantity play in the buy a house for 350 to 500 in today's market, not 4 years ago. Because 350 to 500 4 years ago, you can get a house in in north of Brisbane, you can get a house in Adelaide, right?
Totally.
So in today's world, spending 350 to 500, you're talking locations that don't have a very diverse economy. You're talking, you may get that 5 or 5.5 or 6% yield, but the economy is quite risky to buy into those markets. And I find that there's a difference between an investor-led markets and not. And so I think Melbourne went to a recorrection. I think other markets will tend to go through that as buyers agents stop buying in these locations.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started.
Hi, friend fighters. Let's start with a quick thought experiment. If you could only watch 3 dials to read a property market's next move, which dials would you trust with your money? Now, sadly, most investors just watch the headlines. But our returning guest, Abdullah Nouh, watches what we call tells. He's the guy who can stand in the suburb with a coffee, glance at the numbers behind the for lease signs and the auction boards and say, the tide's turning. Not hocus pocus, but real signals. And when those signals align with the right asset, in the right street, the right block, with the right bones, that's when spreadsheets start turning into equity slides. So here's what we're going to unpack today. We're going to reveal the 5 traits of a high growth asset that he refuses to compromise on so that you don't end up buying pretty problems. You'll learn the 6 boom-suburb signals that he uses to read the rip before the crowd swims there and how to stack them without overfitting the story. You'll understand when to add commercial workhorses for income stability and how to avoid the traps that can turn yield into yelp. Plus, Abdullah will unpack how he tunes the buy box when the rate cycle shifts and how his national lens beats postcode patriotism. Along the way, I'm going to challenge him on what to do when signals conflict, when one dial says go and another whispers wait, because that's where amateurs guess and pros decide. Now, if you missed part 1 of our great chat last week, Abdullah Nouh is the founder of Mecca Property Group, numbers-led, ethics-first advisory, helping investors buy by design, not by default, which is, of course, perfectly aligned with our thoughts here. His calling card is calm, testable thinking. Build your case with data, validate with boots on the ground, and buy assets that you'd be proud to hold when the music stops. Critically, he acts national, not local, and not parochial. He tracks 10,000 plus suburbs to enter markets early because opportunity isn't sentimental, it's statistical. And his business ethos, ethical and transparent, because compounding only counts if you can look yourself in the mirror. So I'm pumped again to dive into signals over vibes, traits over trends, and the practical checklists that de-risk decisions. So welcome back and let's get invested again, Abdullah.
Hey, Bushy, thanks for having me again.
Awesome. Just to circle back, and for those that haven't had a chance to listen to our great conversation last week, can you sort of sum up for us why you do what you do and what separates and distinguishes you from other buyers agents?
I'm really passionate, Bushy, about just how we can create impact, right? And look, I'm only one, my business, I'm only one founder and I've got a team of 10, but we can only impact as many people as we can. But the clients that we are working with, I'm very passionate about how can we create impact? How can we educate as much as possible? How can we just put them in a better position so that they are sort of self-funded? My definition of wealth isn't 50 properties or 30 properties. It's personal to me. It's taking my family on a holiday every year. It's, how can I spend more quality time with my wife and kids as time goes on? You know, being healthy is a big part of being wealthier, in my opinion. So, property just gives you the ability to a little bit of freedom where you're not sort of, you can make choices. It gives you a bit more choices. So that's my why.
Yeah, I love it. And again, as we sort of touched on last week, at the end of the day, property is just a vehicle. It's all about time. It's all about lifestyle at the end of the day, and how much is enough. I guess the other exercise is I get a little bit frustrated by the chess beaters in the game talking about the number of properties, when for me the least number of properties with the least time that requires of me to manage them is actually a better result, because I want to put my energy into friends, family, and making the world a better place. So I love that. So something I'd like to touch on, because in the buyer's agency game, there tends to be players that tend to congregate at two ends of a spectrum. So there's those that bang the national drum and say that they can do anything anywhere. At the other end, there's the very local buyer's agents who just play in their patch. I'd love to get your thoughts on how you cover that spectrum, given that you do have a national footprint that goes beyond the sort of desktop awareness to that sort of intimate local knowledge and understanding of sentiment to achieve superior property purchase outcomes. Can you talk us through how you operate within that?
Yeah, so I think we take the quantitative approach and the qualitative approach. The quantitative is more around the supply and demand metrics, and more around the macro data, like what's happening with jobs and infrastructure and employment. What's the migration forecast look like? What's how many houses are listed for sale? How much available land is there in the region? That's always important, like residential land, and then what's in the pipeline of getting built. I think that's all critical to understand. That's more like the quantitative analysis. The qualitative analysis looks into like, are there more owner occupiers and tenants in the street? Like it's hard because we're not on the ground. I think a local BA on the ground will give you like all the information that you need. It's more like, if I was to buy the house in the same suburb I live in, I can tell you right now where the best streets are and where the worst streets are. Yeah. But I think who has that information is local property managers. If you can find a local property manager that we send to partner up with them, they give us basically all the intel, more the qualitative side, and then that's how we sort of get through that barrier. But you certainly have to take both into consideration.
Yeah, I love it, and I think you're absolutely right. A good property manager who lives, eats, and breathes that location, who knows from one street to the next. Correct. Bad, because the good thing about property managers is they're not going to suggest someone buys a dud, because that problem is going to become their problem.
I agree.
So I love that. That's a good way to balance it off. Again, there's been an explosion in the buyers agents industry over the last few years, but particularly post-COVID, actually, because anyone with a pulse could have made money in property, given the petrol that's been poured on the whole economy as a result of it. But within that, what's one idea that you hear from the majority of buyers agents that they promote that you disagree with?
Yeah, that's a really good question, Bushy. I think it's the more the quantity play in the buy a house for 350 to 500 in today's market, not 4 years ago. Because 350 to 500 4 years ago, you can get a house in north of Brisbane, you can get a house in Adelaide, right?
Adelaide.
So in today's world, spending 350 to 500, you're talking locations that don't have a very diverse economy. You're talking, you may get that 5 or 5.5 or 6% yield, but the economy is quite risky to buy into those markets. And I find that there's a difference between an investor-led markets and not, and those markets are certainly markets that would be investor-led, and like how Melbourne had a recorrection post-COVID. Not that it was driven by buyers agent, it wasn't. It was driven by just a government that put us into lockdown for 2.5 years, and there was an over exacerbation of low supply because people that wanted to sell couldn't, because they couldn't go buy another property. So the ones that were selling were leaving the state. So, and we had, as you know, very low interest rate, very high savings amount. So I think Melbourne went through a recorrection. I think other markets will tend to go through that as buyers agents stop buying in these locations. So, yeah, that's probably what I'm seeing out there.
Yeah, okay, and that's good to know because again, the creases and the grey hair that you see on my head as a result of having lived through quite a few cycles over the years, and one thing I know is that there's going to be constant and ongoing change in those parameters. So being open to where the primary drivers are and tuning into that rather than particularly in the media-driven sentiment, I think is an important thing, because I think, yes, the Victorian government put the handbrake on Victoria, and I think that's been amplified by the negative media that sort of all over that, which is sort of probably blown it out of proportion, but therein lies the opportunity for someone who's a contrarian who looks beyond that to what the underlying fundamentals are. Something I'd love to expand on. We touched on this last week, but and it's I've sort of seen a number of intersecting trends that are coming together on this. But do you think that the growing number of sort of high profile desktop driven buyers agents and podcasters who tend to be really talking up hotspot locations are actually becoming market makers and movers?
Yeah, I think there is I think they have, what you'd call pull in the market. They've got the volume, the volume of clients they're working with, and the volume of transactions they're doing is creating, by default, a supply constrained market. So, yeah, it is concerning. I think, yeah, it's an issue. I think they've also got the ability where people are actually following them, like they're not essentially using their service, but they're joining that sort of circus of buying in these hotspot locations.
What's the best way, do you think, for an investor listening into this to avoid getting caught up on the FOMO that's attached with all of that?
Yeah, I think it's really important just to stick to the fundamentals. You don't have to buy $1 million property that's yielding at 2%. There's certainly different avenues. There's different loan structures available, like we just spoke about before, lease stock loans. There's different products, different locations. Melbourne, although Melbourne gets a lot of negative sentiment around, just like in terms of it's getting a lot of negative sentiment around the land tax issues and the stamp duty and the rental laws. If you actually look into the rental laws and minimum standards, like they allow no mold. Like everyone should be entitled to live in a house with no mold. Yep. Heating and cooling in the living room, big deal. Every house has to have heating and cooling. Windows that lock. Like, are we serious here? If you look at your land tax amount, if you actually look at the actual total cost of holding a house in Melbourne, say a $650,000 home in Melbourne, because there's still some available. Well, let's just call it $700,000. Your land value is usually around $500 if you bought it under a personal name, you're probably only paying around $1,900 to $2,200 in land tax, right? Don't quote me, but it's somewhere around there.
If that actually.
If that. Yeah.
If that, the numbers.
Correct. Yeah. Now, if you were to buy one house in Melbourne, that's nothing. Now, if you look at the property management and insurance in Melbourne, property management is 5 to 5.5%, including GST. Yeah. You buy the same house in Brisbane, 7.7. Yeah. The insurance, look, $1,200 to $1,800 I've seen. Again, Brisbane, $2,000 to $4,000, depending on the location. So, so if you look at the holding cost, even with land tax, you're probably in an equal or maybe a slightly better position. Yeah. Right? So don't get caught up in the noise. Yeah. Look at your budget and look at what locations you can buy in. And I think stick to the fundamentals, because you can't do wrong. You can't go wrong with fundamentals.
100%, and it is getting granular with what the true numbers are. Again, I don't know about you, but it's something that we assist with clients with is getting intimate in relation to every cost involved in buying and holding a property concern, so you can look at the true weekly holding cost over the years, so that you can actually plan that out and have some confidence around the cash flow affordability. But those things that you've mentioned, when you actually plug them in and compare them with other areas, suddenly Melbourne doesn't look anywhere near as bad as what people have been trying to make it out to be. And the other thing that I think is important here too, Abdullah, is that Melbourne is leading the charge in terms of standards. So what's happening in Victoria is rippling out across the other states. So it may not be in place in some areas now, but property management, residential tenancy codes and whatnot, all of those compliance changes are actually progressively happening everywhere. So it's a bit of a false outlook to think that Melbourne is the bad agent, when in reality it's getting ahead of the game in that context. And it's, as you've touched on, it's the key drivers of property value that underpin all of that is the more important things to focus on. And I'm going to get you to unpack those shortly. But let's now go back to the investor level, because ultimately, most of the people listening in are investors, either aspiring or existing. From your perspective, given the experience you've had in the game, what are the common mistakes that you see property investors making?
I would say the common mistakes are, like structuring. They don't think about structuring at the start of it. Even the loan structure sometimes I find incorrect. Just around, cross collateralization versus not. You'd understand that quite well. I find just getting caught up in the sentiment as well, like buying a house that in a location that you grew up in because you have sentimental connection to it. I find that could it could be complete chance that you've done well, and if you didn't do well, it's because you didn't do your homework. So, I was quite lucky. Like the first one I bought in Melbourne, it was in an established suburb. We lived in the suburb called McLeod.
Yep.
We're northeast of Melbourne, and it's a beautiful suburb. So we bought next to it in Mill Park. And look, it's done very well over the last 15 years. So I think it just I was lucky. How if I was raised in Melton, it'd be a different story.
Yeah. Yeah, no, good point. And I often say the same thing. It's better to be borderless than backyard, because the chances that your suburb, amongst the 15,000 around the country and the 11 million odd properties that are up for grabs, are the highest growth opportunity. They might be, but it'd be luck more than good management, versus someone like yourself who has the data to really read where the opportunity's going to come from. But how do you and the Mecca Group uniquely help buyers overcome some of these issues then?
Yeah, so we look at fundamentals, like we value property like valuers do. Some, not sure if I told you, but I'm doing my master's in property development, which I'll get an accreditation to become a licensed valuer by the end of it. Awesome. So one of the subjects we did was evaluations, a few subjects, and I did it because I just wanted to understand how do valuers actually value property, because that's And one of the things, if you look at how they do it, it's actually interesting. They look at like market risk, right? So these locations, these regional locations that are doing really well, if you look at any property that gets purchased in these areas, their risk rating will be very close to 5. If not 5, it would be probably 4.
Yeah.
Right?
Yeah.
They look at zoning, contour, is it flat? Zoning means if you have a high density zoning, it means you can further add value with potential development down the line. Yeah. Contour is, is it flat? Is it on an incline, decline? These are all factors you have to take into consideration, because, in 10 years' time, I know if you buy a property that's on an incline or decline, you're going to wipe out a certain percentage of buyers in the future that will be interested in it.
Totally.
Then we look at environmental hazards. Are you parked under a high voltage power line? Right? I see this a lot, actually, where a client would, show me a property and go, well, why is this worth $1 million and you're making me buy a property for 1.3? Well, then I look at it and I'm like, well, it's because it's under high voltage power lines.
Yep. In fact, the bank, if it's within 50 meters or more, quite often the banks won't touch it when it's close.
Yeah. Yeah, we've actually seen it where LMI companies won't insure it, so you'd have to go minimum 20%.
Totally.
So we look at environmental hazards. So so high voltage power lines, substations. Then you got flood overlays. Now, flood risk and flood overlays could be different. You can be in a flood prone area, which is risky because it's probably most likely in a lower floodplain area, and you can actually get flooded. And you can buy in a flood risk, which is potentially just a risk because of building standards changing or too many old houses there. So just need to look into that. But yeah, environmental hazards. We also look into the configuration of the home, the building size of the property, the land size, the orientation of the land. You're buying a triangle, you're buying a rectangle. Are you on a corner block, inline? So I would say, the fundamentals as to what's actually important when you're looking at buying the actual asset, right?
Yeah, no, well said. I think a growing area, and I would like your comments on this, Abdullah. Given the increase in extreme weather events that are happening around the country and its impact on insurers, we know firsthand, and one of the early due diligence exercises that we now get investors to have a look at is to check with an insurer as to whether that property is insurable and what sort of premium are they likely to pay on it, because that's a big indicator on risk. And there are insurers now that you need to talk to them, because they won't blanket a postcode, but they'll blanket certain areas within that postcode where they will or won't insure. And if there is high risk, then they'll impose a much higher premium as a result. So that in itself, to me, is an indicator that needs to be looked at pretty closely. Is that part of the mix for you? What are your thoughts around that?
Yeah. We tend to do get an insurance quote for every property that we present to a client, because that's how we understand the cash flow. We insert that amount to the cash flow analysis. Yeah. But yeah, that's very important. Very important. But look, if you're buying in, regional Queensland, yes, that's risky. But if you're buying in Melbourne, not really.
No, totally. I love that. Let's dive into the DNA of high growth investment property then, because I know you've written a great article on the 5 traits that are associated with that. So can you sort of break down, give us a quick bullet point summary of the key traits that you think are associated with high growth investment property, and then unpack each of them in a little bit more detail?
Yeah. So when it comes to how to identify high growth, you want to be buying in a location that has a supply constraint in terms of, you don't buy in an area that has a lot of land available. You want to look at an area that's quite established. So if you look at, for example, where Sydney is today, right? If you look at Western Sydney, 10, 12 years ago, that area, those areas were between sort of $700 to $1 million. I'll use Greenacre for an example. 12 years ago, that was between $700 to $1 million. Yeah. Today you're talking 2 to 2.5 for a nice 4-bedroom, 2-bathroom home. So, if I look at historically what's causing this price growth, and it's just the lack of supply. That area, the number of listings that are available in that suburb are always lower. It's got less than 3 months worth of inventory, always. Yeah. Right now, let's take it to Melton and say Wyndham in Melbourne. You've got anywhere between 5.5 to 9 months worth of inventory, right? So if I'm a buyer and there's no market pressure, I've got ability to negotiate. Yeah. But if there's always market pressure, you're going to see that capital growth come through over time. And it comes back to affordability as well. I think, as you said before, I think Melbourne has been heavily criticised by the media. That has sentiment is certainly a play in that. The second one is I like to look at the economy, right? What's the economy within the region? We're seeing job growth. If you see job growth, if you see job advertisements go up this time compared to last year, then you know that they're looking for people. It means you're likely to see more people move into this region, because they may open up, the state may open up visas, skilled migrant visas, to come in and backfill these openings, these positions. I'd look at, I'd look at the rental market. So, what's the vacancy rate for the region that you're buying in? what's it been like over the last 3 years. I'd even go to open homes, see how many people are in there looking at homes. That gives you a very good indication as to, who's there, how many groups are coming through, how many applications are coming in, how long does it take to lease out. I'd also look at the so I've got a brain fart moment. It was 5 traits, wasn't it?
Yeah, so I think we're probably more touching on the location detection opportunities here, and we might revert back to having a look at drilling down into the high growth investment property traits separately in a second.
Okay.
So you've covered, from what I can see, you've covered the supply constraints. So you've got limited land and zoning. You've talked about the rental tightness around vacancies, etc. If we have a look at those sort of location selection pieces, there's sort of 6 key ways you've mentioned in an article that you wrote recently around that, and I've summarised them. So I'm one of these people, Abdullah, who if I can't put things into a really bad acronym, I don't remember it. So I've actually summarised yours as what I call SPARKs. So if we break the SPARKs down, it's supply constraints, population and paychecks, access and amenities, rental tightness, the knowledge edge around the raw data over recycled stuff that you see in the media, and stock shrinking as those. Do you want to break any of those down a little bit further for those that are trying to get their head around where they should be looking?
In terms of locations?
Yeah.
Yeah, okay. Yeah, that's a good one. So I would actually look into, if I was right now on the market as an investor, and say I had a budget between 650 to 800,000, I'd be looking into so there's 2 parts of Melbourne that I like, right? So I'll be looking to Melbourne, but there's the east and southeastern corridor. I find there's a lot of value in, mainly because it's supply tight. There's not a lot of land apart from Officer and Pakenham that's available.
Yep.
And you can get into these more established suburbs like Bayswater, Baronia, Ferntree Gully. You can get a nice 3-1 on 700 square meters between 800, between sort of that 750 to 850 range on a brick veneer. I'd also look into the inner north, so not outer north, like sort of in the city of Hume. I'd stick to the city of Merribeck, Merribeck City Council. There's 3 suburbs there that I really like. I still think they're still affordable for the location they are to the city. So if I was to break them down, I'd say Fawkner, Hatfield and Glenroy. I just think those 3 suburbs, they're just too close to the city. You can still get stock under 900,000, 750 to 900. What we did for a couple of clients, Bushy, is some of the yields were quite low, like 3.8%. So we actually helped them get a granny flat built in the back of these properties, and they're getting about 5.4, 5.5% yield. Right. So they're getting both. You're getting the best of both worlds. They're getting the capital growth. Capital growth comes from land, and then the granny flats giving them an extra $500 a week in rent. So it's good. Yeah, that's what we're doing.
Yeah, great. So if we for someone to get to those locations, if we templated the framework that you overlay in terms of the key metrics that you're using, and again, using that SPARKS framework that I mentioned, supply constraints, population, paychecks, access and amenities, rental tightness, the knowledge edge and the shrinking stock, how do you apply them? How do you rate them? And if there's conflicting signals coming out of those SPARKS indicators, when one of them might be saying, yeah, go, and another saying, well, let's maybe. Can you sort of talk us through how you apply that to then, and for example, there might be falling inventory but rising new build pipelines. About how you assess all of that.
Yeah, so you look, if you were buying a house on a land above 500 square meters, like on essentially the original title, the original subdivision, I would say that even though the new pipeline is high, the new pipeline most likely is townhouses or units. So the value of that property, given that it's over 500 square meters, most likely you can do a duplex on that. So the value of that land still would be quite would still, you're not competing against townhouses. But if you were to buy a duplex or a townhouse or a unit, and you got that high supply pipeline coming in, then I'd be concerned. So that's I think that's important. Population, I think look, the location these properties sit in, these locations that I just shared with you, they're all in established locations. And if you look at, I think people underestimate the ripple effect. So as the suburbs preceding it are getting more and more expensive, what happens is those buyers from those suburbs end up going to the next suburb. So I think you'll find that in Ferntree Gully, even though it's quite a distance from the CBD, if you look at the suburbs preceding that, you got Glen Waverley only, I think, 7 or 8 k's away from that suburb. And if you get a house in the school zone, it's like over $2 million. So, so it's important to understand you're not buying in the most expensive suburb, but it's like you're surrounded by quality suburbs. And that's important. So that's population. I think the rental is important too. I think important to understand what the demand is for rental properties. You probably wouldn't want to be, buying the most expensive property thinking you can get a 4% yield. You probably want to be looking at the 3-2s, the 3-bed, 2-bath, or a 3-1 that can be converted into a 3-2. And people really like 3-2s. It's also important to understand the demographic of the location. So the inner north generally has blue collar, which means, you might want to have a nice shed or a garage because that's where they store their equipment or their tools. Whereas the east is probably more white collar. So just understanding the understanding the demographic can help you tailor what type of property you purchase. And then I think you said knowledge edge.
Yeah.
Could you elaborate a bit on that one?
Well, yeah, I might switch gears a little bit actually, because I think you've given us a really good breakdown on that. One of the other articles I read that the AFR run not too long ago was around the key traits of high growth investment property, and you mentioned location, land, environmental risks, supply constraints, and value add, which we've touched on a little bit. Which one of those 5 traits do you think is most underweighted by investors and ends up creating issues for them? Can you sort of give us your thoughts on that?
Yeah. Well, it's a tough one because I think each of them. I think the first one I said was they buy the wrong property. They don't have a clear strategy, right? And we spoke about strategy in the first session, how important that is. Their financing is poorly structured. I think we spoke about that as well. They lack the right mindset. Again, we spoke about, I think I had a question once from someone saying, I don't understand how to create wealth. How can you help me do it? I was like, well, you need to create the right mindset and get the right team around you. Number 5, the last one was they don't leverage your equity. I think not leveraging equity in the more established markets, I find where people are sort of comfortable and they're sort of in their, 35 to 50 years of age. They've got enough equity now. They've got cash in the bank. They've got super. And they're just like living in that comfortable stage where they don't want to over leverage and too scared to make the wrong decision. I think that could help. That's probably the one that I look at and I think probably is probably the most detrimental out there for opportunity loss. But in terms of the most critical one, I think the lack of strategy, I think, at least those guys are in a good position, but the lack of strategy can really kill can really decimate your future plans.
Totally agree. Something I wouldn't mind you expanding on as well, because as you mentioned last week, we've gone from zero information 20 years ago. I mean, when I first started in property, I relied on the Saturday paper highlighter. Pretty much spent all day Saturday driving the suburbs and going to opens, to now when we've deluged with so much information, we're drowned in data now. I'd love your thoughts on some of the metrics that don't matter, because I get a sense that a lot of investors are focusing on things that don't move the needle and ignoring some of the data that actually is making the difference. Can you sort of shed your view on all of that?
Yeah, that's a really good. Look, I think I agree with you. PropTech is huge now, and I don't know how many different videos and websites do you see now that do PropTech. Like the information is, it's probably overload. It's like it could be what's the right word? Overwhelming. That's probably the right word for it. Yeah, I think the one that I probably don't get too caught up in. It's like really important to have a look at the suburb you're buying in and understanding the number of houses in that suburb, because when you look at this PropTech information, you look at like 2% stock on market. What the hell does that mean? Like 2% of the listed properties are listed for sale over the number of dwellings in that suburb.
Yeah.
Like, how do you measure that and think, okay, if it's under 2% or under 1%, it's a really good investment region? Like, I think that's, that could be manipulated at the start.
Yeah.
I think the one that probably people don't take enough, but I think the one that I think people should be looking at more is around the percentage of renters. You don't want to be buying in an area that has too many renters. I think that's like a qualitative analysis.
100%.
I think that one's really important.
Yeah.
What's the other one? Vendor discount. Like, what the hell? Like, why are you even talking about that? So sorry, Bushy. But like, why are people talking about vendor discount? Like, if you follow most real estate agencies underquote anyway to try and get the maximum quote. So why are we even looking at that as a stat?
Yeah, I agree.
You hear me?
100% meaningless. That's why I say it's measuring things that don't matter and avoiding the elephant in the room that's actually making big moves. And often I think the areas that I think get the least attention, but are the biggest drivers. But if we're talking scarcity, and we've got a tight location, so not in greenfield. For me, I often talk about the 3 I's of growth. So new committed infrastructure that's not necessarily there yet, but we know it's coming, and it's not a politician's promise. It's actually
Committed.
New industry diversity and growth, because that's going to drive the jobs, and then strong and growing income demographics underneath that, so that as prices rise, people can still continue to afford paying for them, and it doesn't become a handbrake. For me, they're the areas that I think are the most important, but the least actually spent time on. People like yourself would do the work, but the average hunter doesn't start chasing state, federal, and local council records to look at the infrastructure spent, what's been approved. What's your thoughts all around that?
Yeah, no, I think you're spot on there. Infrastructure spend is really important to understand how a market's going to move, and affordability. I think if you look at the one of the reasons why Perth grew, regardless of buyer's agents or not, I think Perth had huge affordability. Like, the incomes were so high. And that, during COVID, once supply was restricted, we saw price growth that was quite consistent. And I think it was I'll call it a recorrection. Perth is probably at the right price now. I think you had a bit of a period where prices came back a bit earlier in the year with high levels of listings, but that's sort of settled out, I think, now with buyers agents more focused on other locations. But yeah, I think the 3 things you just mentioned are really important. Like, if you look at the Northeast Link, that's happening in Melbourne. I think once that's built, that's going to allow more access to the northeast of Melbourne. So the northern suburbs will be connected to the eastern suburbs. Those suburbs around there, I think, are gold mines. If you look at the Westgate Tunnel, that's going to provide more access to the west. I don't think outer west is good, but I think inner west, like Altona, you can still get a house in Altona for like 800,000. Like, man, that's like so close to the city, So I think what you said is really good.
Yeah. Okay. Well, let's sort of shift gears a bit now, and because we've touched on this a couple of times last week as well. You wrote a great article championing commercial property for sort of cash flow and inflation protection. I'd love to talk, because again, it's become flavour of the month, as we mentioned last week, and everyone's wanted to talk about commercial. But from your perspective, if and when should a residential investor pivot to commercial, as far as you see it?
I think commercial is a fantastic investment to get into. And Bushy, if I have a client that comes to me and says, Abdullah, I've got like 400,000 to spend, I'll do a house on granny flat, I'm like, no, let's go buy you a commercial property. Now, commercial, though, can be risky. So the more money you spend in commercial, actually, the better quality investment you get. It's opposite to residential, right? You don't want to be buying a $400,000 to $800,000 commercial. There's far less opportunities in that space than say somewhere from say 800 to, even up to 3-4 million is really, really good. Look, I'll tell you like a one case study that is probably one of the best case studies I've done in commercial. I had a client come to me. He had no debt, right? He had a dentist clinic. He owned the business and the site. He had a property that he lived in, and he had a block of land, no debt, about $3 million. All up was $5 million worth of assets, and zero debt. And he's saying, Abdullah, I want to get out of this clinic. I want to be able to transition out of it. I need to replace my income. I'm looking for $20,000 a month, and I've got 1.2 million in cash. Now, he said, I'm happy to buy 5 properties with you. What are your fees? I was like, yeah, I don't know if, I wouldn't do that. Anyway, so I went away, came back to him. I said, look, I actually think this is the property you should be buying. It was a $3.5 million commercial in Yatala, which is like between Gold Coast and Brisbane. The tenant is great fit for the location and the market that they service. And he had a net yield of 5.85 on a 7+5+5 lease with like a 6-month bond, right?
Wow.
So I said to my client, look, I know you didn't want to spend that much, and he didn't want to spend 3.5 in one hit, right? He just wanted to buy these little $400,000 properties. I said to him, look, I'd go quality over quantity. If we look at this property, it's already giving you that 205,000 income. In the next 3 years, that should go up to 222. You should be able to cash out of your business in 2025, pay the debt off, and you got the money. Right? Bushy, that's exactly what he did. He just sold his business 3 months ago, settled, I think, recently, like 6 weeks ago. And he's now owning that. He's now doing this locum work as dentist. Like, that there is what you call, like, in my opinion, that's like understanding, like building that strategy for the client and not buying these 10 or 15 properties, just get the one that they need. And then, and the rest is history.
Yeah, I love it because you've matched strategy to their lifestyle stage as well, because he's transitioning from full work to retirement. So cash flow is got to be the income flow that's key, and taking advantage of the very different world that commercial presents to create a much higher yielding asset without all the headache associated, and that the tenant is responsible for the outgoings and tried to keep the property looking good, then the maintenance and the time involved in managing that asset, significantly less. If you've got a good magnet, a long-term tenant like you've just described with the lease conditions, so that's a bit of a no-brainer from that perspective. You touched on this already, because this is something I would love for people to really tune into, because it's flavour of the month. What are your thoughts around, what commercial asset types, price points, and locations should people be taking into context, and as well as the ones that they shouldn't be focusing on at the moment?
Yeah, so if we focus on the asset class first, I would give offices a miss. And even if they had a government tenant, I just wouldn't go for offices. I think the office space is going through an aggressive recorrection. The working from home thing, people now work differently, right? Look at you and I. If you asked me 5 years ago that we're going to be on a podcast over Zoom, I wouldn't believe you, right? It's just the way of the world now, yeah? So offices I wouldn't bother. Retail, be careful what locations you're buying in. I know the Melbourne retail market has copped a really big hit post-COVID. There could be some options, but retail can introduce risk. Like if you're dealing with a mum and dad business, like that's a cafe owner, it's reliant on people coming into the office. If it's in the city, I'd be concerned. If it's a high traffic environment, it could be okay. You've got so I'm going to talk single use sites. So you've got petrol stations and medical centers. Again, they are okay, but they are only they're single use operations. So when you talk about how valuers value risk, a bank would look at that and go, if you're buying a property on a lease doc loan, if it's single use, correct me if I'm wrong, but the max they'll give you is 50%.
Totally.
Yeah. If it's multiple use, all of a sudden now it's attractive to multiple tenants. Yeah. So this is why industrial is an asset class that is it's low risk. It doesn't give you the highest yield. You can start at somewhere like 5% net, which is still pretty good. and you can go anywhere up to 6%. And the locations that I'd be looking at, look, Melbourne right now, I strongly believe Melbourne right now is at its bottom, even with commercial. We are looking at a commercial industrial property that's 450 square meters net lettable area, ranging for 82K a year with a long-standing tenant. We can probably get it for 5.7%. I think that's a huge win if we get this across the line.
Totally.
If I was to show you a market that's absolutely smashing its peak, that's at its peak, I would say is Gold Coast. Be careful what you buy in Gold Coast right now. I wouldn't be buying strata sites there. They're building heaps of them. There was one to contrast. I'll just mention the one in Melbourne, 451 square meters, 1.45. 1.35 million in Gold Coast on a strata site, not freehold like the Melbourne one. Yeah. It's renting for $78,000 a year. It's over rented, by the way. You got to look at the market rent. The market rent is, I think for that area is $460 a meter, but that's what they're advertising. The market rent's about max $340. Like it should be about $270 to $340, right? Okay. For a small strata site. But they want 1.35 million for that 168 square meter commercial industrial, right? And where you can get, and why that site isn't good is the zoning on that site only allows for storage businesses. So you got to look at the zoning. What type of business use can you get out of it, right? So with commercial, like you can't use the residential lens. You got to look at zoning, use, how many different uses. The more tenants that are interested in it, the better it is for you. Don't focus too much on the getting the maximum yield. But in terms of location, I'd say Melbourne is still is probably bottom cycle. I think Perth. Look, I've been to Perth a few times. Is the business I suppose that the business network in Perth is so strong at the moment, and there's not enough commercial assets available. As long as you're not paying above market, I think Perth still is a very good option for commercial industrial. And then there are some pockets there. I think regional New South Wales is also quite good, around the Newcastle area, on your way up to Newcastle, Gosford. I think you can still get above 5%. We just brought one above 5% there. So I think the landscape is good. Just have to be mindful where you're buying. I think Adelaide's also good as well. Adelaide's an interesting city. It's wedged between the hills and the water. So it sits like that. And there's not enough land to build more houses or more commercial facilities. So Adelaide's not a bad long-term play as well.
Yeah, I've lived there for best part of 40 years, so I know that patch of dirt extremely well. Broadening out a little bit then, because you've touched on quite a bit already, and I'm thinking not just commercial, but residential. What's your read on property conditions in the medium term, and where and what are the best opportunities, do you think?
This is for residential?
Yeah, you've covered the commercial piece pretty well. Residential place, what would you think?
Look, I love properties, Bushy, where you can continue to maximize and create value out of it, right? So I love like a corner block, 3-bedroom, 1-bathroom that you can convert into a 3-2 and potentially build a house or a granny flat in the back. That's street facing. I think by far they have to be the best residential investments out there.
Yep.
I just can't see anything. Yeah.
Growth. They've got the combination there working pretty well. Yeah.
Correct. I love also houses where you've got a wide enough driveway, right? So look at what the local councils, every local council has different metrics around how wide the driveway has to be, but a rule of thumb is 3 meters. If you have 3 meters in the driveway, and you have enough room in the back, most likely you can build secondary dwelling in the back. So, those houses are good too, because you can renovate the front, build in the back. You got income on both. You can sell them later. You can maximize value. So I love the residential investments where you can continue to maximize value. Now, Adelaide had a massive opportunity because it is actually the second most dense city in the country, right? Melbourne, so Melbourne and Adelaide 1 and 2. So I think Melbourne has that opportunity, and Adelaide's already grown a lot, but Melbourne has that opportunity. So I think those residential assets I love. Now, a new townhouse, a new duplex, new house down in Wyndham, I don't know. Not a big fan.
No.
Not a big fan.
for the reason that we've already touched on, really. Let's circle back to Mecca Property Group then, because for those who are really resonating with what you're sharing with us today, what's the profile of property buyers, whether they be investors or others, who both are and aren't the best fit to work with you and your team?
Look, the best fit at the moment is those clients looking for foundational assets, like the residential I just told you about. In that sort of 650 to 650 plus range. I think for 650 is a good entry point into Melbourne. Hard, but it's doable. And there's commercial clients. There's clients, Bushy, that probably have one or two investments or one property. Then they've got some cash, got some super, and they're looking to sort of build a strategy. They're probably those clients fit with our profile really, really well. When I first started, 4 or 5 years ago, it was quite different at the time. You can buy a $400,000 property in Adelaide in a very, very good suburb. Those times have changed now. So, yeah.
Yeah. What about the flip side? Those type of buyers and investors that aren't a good fit for you because it's important to attract the right tribe? What's that look like?
Yeah. So I think the ones that are really the ones that ask me, generally speaking, they ask me for a discount. I generally think that they're not the right fit for us because they don't understand the value that we bring. So if you're concerned about what you're paying a buyer's agent, probably not the right fit for you. If you just want someone to buy one property, not the right fit. We really really want to be with the client throughout their life cycle. That's our that's our selling point to our clients is we want to be with you guys. We want to see you grow, and some of the case studies we have with clients who have now got 4 or 5 properties, some that are transitioning out of these short-term markets into more quality assets. Those clients are, it's different. It fulfills me differently. So
totally, I often say the same thing. It's a marriage, not a date. Because you're looking to grow with them, and the satisfaction that everyone gets out of that process. You can't put a dollar value on it, actually.
Yeah.
Okay, just to wrap it up before we jump into ambush round number 2, what would be your sort of key takeaways for property investors that are listening into the conversations that we've enjoyed over the last 2 weeks?
Yeah, maybe just look at maybe ask yourself the why and what is your definition of wealth? Everyone has different definitions, and then once you know your definition and your why, then start to get the right team around you. Look, there's not one size that fits all approach. Everyone is different. Everyone comes I've been bashing, people that focus on short-term markets. Openly, I'll tell you that we've had clients that have had to go there, but you need to have a way out. So it's, just make sure that you got the right team and just start working on that mindset.
Yeah.
Mindset's very, very important.
100%. Totally agree. And let's jump into the second bushfire lightning round then. Abdullah, starting with, what's your favourite quote and why?
Hey, favourite quote and why? I would say I don't know if this is a quote, but I really focus on how people always remember how they were treated. So treat others how you'd like to be treated. I think if I can say one key takeaway from interactions I have with people, it's generally the one thing that brings them back or why the network grows, it's because of the way they get treated. So I'm very big on I'm a very values driven person, so I'm very big on that.
That experience is the thing that makes a difference at the end of the day. Slightly different topic. What's the top book that you'd recommend we read and why?
Top book to read and why?
Yeah.
Oh, well, it depends what industry you're in. Well, look, for property investors, because we're talking to property investors today, I'd say, if you haven't read Rich Dad Poor Dad, that's a timeless book. It's such a fantastic book, and it just really is you'll be the precursor to change.
100%. Yeah, it's an absolute timeless classic, as you say. Completely different subject. If I gave you $50 million in cold hard cash right here, right now, what would you invest it in or spend it on, and why?
Okay, very good. I would start to look at diversification of different investments. If it was $50 million, I'd probably leverage against it. I'd probably be buying a site like there was a data center that was selling for 62 million with a 6.1 million rental on it, 10% net in the southeast on 33.2 hectares. I'd probably buy, leverage against it, buy that. I'd probably buy, I'm really starting to enjoy or look into self-storage sites. I think self-storage sites have really big value adds if they have the ability to add more units. Self-storage, so anyone that's concerned about, what happens if a tenant leaves with an industrial unit and there's a vacancy period? Well, industrial units, they're all small, so you don't really feel it, and you can work off a 95% occupancy rate. So I'll probably do a few self-storage projects. I think they're really good. I would probably purchase a block of units very close to the city in Melbourne.
Yep.
On good sized land. And I'll probably buy some farmland that's about to be rezoned.
Like it. Yeah, there's a good mix of future opportunity in there and good cash flow to boot. So that's a pretty balanced portfolio that's low risk as well. I love that. Love that. Again, different subject again. If you could wave a magic wand and change anything, what would you change in property to ensure better outcomes?
I think you mean the property journey of acquisition, or
it could be anything. It could be again, one of the things that's back on the table is that this nonsense talk about getting stuck in a negative gearing and capital gains, which for me is cutting off by the face. So if there's anything in the whole property sphere that will change, what would that be to produce a better outcome for everyone?
Yeah. So look, I was actually I was invited to an event and he had a politician there. I won't name him. And they were sitting next to me, and it was like a networking session. And I heard this politician on the news last year this year when we were going through the elections, mentioned it was like a topic around how they need to remove negative gearing, stop the CGT threshold and all that. Anyway, I actually sat with this particular person and said, look, what is your understanding on why prices go up? There is very little knowledge in our political sphere on what actually is creating housing to be unaffordable. Yeah. And it's a simple equation of supply and demand, right? Totally. Now, investors are the only ones that open up supply for tenants.
90%. 90%.
We are 90%.
Is provided by mum and dad investors.
Correct. So why create more red tape, right? Like in 2015, when they brought out the ethical lending standards, Bushy, they made it more difficult for investors to get in. Queensland taxes investors more than owner occupiers. So, if you want to sort out the issue with supply, right, and you want to make housing more affordable, remove the red tape. That's number one. Number two, there needs to be someone needs to take better control of our planning schemes, right? Councils have too much control. Neighbours have too much say. Yeah. If something meets the requirements, it meets the minimum requirements, the person should be able to create that supply. Right. So I think, and it was interesting. I sat with this particular politician for about an hour, and she had this notepad. She was just writing heaps of notes. And I just said, just don't tax investors, because that's going to kill your campaign. Two, it just shows how removed you are from the actual root cause. Yeah. But you need to be working with developers. You need to incentivize investors. But your policies, so if you look at all the policies from our politicians, they're all demand-driven policies, because our political system, they're only alive for 3 years. Right? Exactly. So they're all short-term driven policies. Yeah. So someone needs to actually be courageous enough and let's bring in some long-term policies in place. Let's actually focus on supply, because this 5% no deposit scheme, what's that going to do next year from January? It's going to create more competition.
Demand driven. Yeah.
Yeah. We're making it more affordable. No, you're not.
No.
You're making it more accessible. If the issue is still there, which is supply, well, guess what? So, it just like really, really bothers me because there's a misconception out there and a misunderstanding out there that investors are the demons of this, but we're not. We're actually trying to solve the problem. But we've been demonized because we're an easy scapegoat.
Well, they're convenient donkey to pin a tail on because there isn't a strong, united investor voice. Mum and dads who are busy building their businesses and looking after their families. So there's no lobby group that really protects those, and therefore it's easy target. I get really frustrated. I guess final question then to bring it all to a close, Abdullah, if I ask you to get invested, what does that mean to you?
I think invest in yourself first. Yeah, invest in yourself first. I think you'll get more growth and you'll make you sharper and make better decisions that will propel you for further growth, whether it's through property or other aspects. So,
love it. No, well said. For those in the audience that really have resonated with your message, we'll make sure we've got all of your contact details in the show notes. And I just want to thank you for your great insights, Abdullah, because as we come to a close, I just want to sort of land some of the take-homes that the listeners can stick on the fridge door. And the first of those is focus on signals, not vibes. Low vacancy, funded infrastructure, job growth, falling stock. If you tick those, then you're not going to be guessing. You're going to be surfing a rip that's already running. Traits trump trends, as you've said well throughout the discussion. So buy the right asset in the right pocket. Look at the land, the risk, the scarcity, the value adds, because trends fade, but traits compound. And then sequence your strategy, as you've talked about quite a bit, to make sure you're matching your stage of life and your serviceability so that your portfolio throws cash in when you need it. And if anyone listening is ready to turn today's insights into your next move, feel free to book in with me for a personal solution session where we can develop your freedom numbers, your capacity to drive your property strategy. As we close, we want to make sure that we're bringing intent. I'll bring the instruments so that you can get invested by design, not by default. And as we close, another big thanks, Abdullah, for sharing your wisdom and your calm numbers first clarity. If this has helped, make sure that if you're listening to follow the show, share it with your friends and drop a quick review so that I can be fine-tuning this to make sure we're adding the right people with the right content. And all links, notes, and otherwise will be in the show notes. So thanks for lending me your ears and your ambition. Until next time, stay curious, stay generous, and get invested. So thanks again, and let's keep the conversation going, Abdullah.
You're welcome. Thank you for having me.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.